zombie companies. So central bank zero interest rate policy, or ZIRP, and negative interest rate policy, or NIRP, have had either intended consequences or unintended consequences for creating, sustaining, and rewarding zombie companies. And the twilight zone, the new normal in air quotes that we are in now, just continues to get even more weird, even more distorted, even more bizarro world. Today, CNBC released an article from Jim Bianco, founder of Bianco Research. He's a very well-respected global macro researcher. I believe that corporate debt passed, negative yielding corporate debt passed the $1 trillion in market value for the first time in history. And negative yielding corporate debt, it's a relatively new thing, I guess. It's rising from just $20 billion in January, and not even 9 months later, here we are over 1 trillion. You should really see this chart that Jim Bianco has from Bianco Research in this CNBC article. This thing it's gone totally vertical. It is freaking crazy, guys. So this is not the concept of negative rates. It was intended initially mostly to be for government debt and copy Japanification, financial repression. But of course, predictably, there's been a lot of spillover. As the lower and lower interest rates go, the more corporations with bad balance sheets, with cash flow problems, play the refinancing game, which is they know that they can't ever pay back the principal on the debt, so they're just in the game to refinance and keep the game of musical chairs, basically delaying bankruptcy, delaying full insolvency as long as humanly possible. So the Bank of International Settlements, or BIS, has actually been tracking a lot of these things for years now. I've been interviewing people like Daniel Akaye for the last couple of years about things like this. He's been monitoring this. I believe in 2017 or 2018, there was, according to BIS reports, and the Bank of International Settlements does extensive research on this every quarter and also every year. And I believe it was 10% of all companies were zombie companies, meaning that they could never, mathematically, their cash flow, they could never pay back their debt. They were just in the refinancing game. They could only pay the interest payments. It was like the equivalency of if you don't own a company and you're not familiar with this, with how company finances work, it's basically the equivalency of just making the minimum payments on your credit cards so your credit rating isn't totally destroyed and your credit cards aren't shut down, and maybe opening up other credit cards. And this is what these zombie companies have been doing for a very, very long time. So basically, the lower and lower that central banks, the larger central banks, have decided to manipulate interest rates, the more these corporations, whether they're large corporations like GE, corporations not on publicly traded stock exchanges, or smaller companies on stock exchanges that are quite a bit smaller than General Electric, they've decided to play this game where they would use debt rather than equity, unless they're shale junk bonds, because shale was using both. But a lot of these companies saw that debt was cheaper because interest rates were falling, and rather than repair their balance sheets with the cheaper debt and have better finances, they were taking on even more debt and using the debt for share buybacks, for leveraged buyouts that often did not go anywhere near as planned. Boring Name says this has been an issue for 10 years. Yes, Boring Name, but it's gotten worse and worse and worse. And this is an unintended consequence of taking interest rates down. I don't know if central banks actually planned that the corporate bond market in the U.S. would go from $5 trillion up to about 10.5. It was 5 trillion something about 12 years ago, and now it's almost 11 trillion here in the US, the official corporate bond market. But a very large chunk, 40% of all corporate bonds here in the US, are triple B, and they shouldn't even be triple B. Triple B rating, if you're not familiar, is one rating above junk. Danielle DiMartino Booth and Jeff Gundlach and others have warned about this, that basically these companies should be rated as junk, but they're not. And there's a lot of very rosy, very unicorns and rainbows, very, 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 very optimistic assumptions within all the cash flow projections and the finances of these companies, to where there's a tiny justification for why these companies do not have junk rating. And the amount of junk debt has exploded as well. I think we're over $3 trillion now in junk bond debt issuances in the U.S. corporate bond market. Just an enormous amount. So it won't end well. Even in Europe, I believe in July, let me check the exact date here. July 10th, the articles came out. I was talking about this, but this all fits together, guys, that even in July, even recently in July in the European Union, there was even 14 junk bond companies with negative yields. That's how crazy things are getting. That's the distortions that the European Central Bank, or ECB, is causing there. And the yields, obviously, for government bonds in Europe, European Union government debt of those countries is way below the risk. Way, way, way below the risk. There's no real demand for those bonds. I have articles here warning about the Bank of International Settlement reports. Goldman Sachs, this article is from, let me get the exact date here, September 23rd, 2018, so almost a year ago, about 11 months ago. And I was definitely talking about this then. Goldman Sachs wrote a research report warning of a default wave as 1.3 trillion in debt is set to mature. So 1.3 trillion in debt for corporate bonds is due to be refinanced over the next 5 years. And obviously, whether this is intentional or unintentional is up for debate. But the central banks, I think the main reason the central banks are manipulating interest rates lower is for government finances. But the other secondary, maybe tertiary reason is for corporate bond finances, corporate debt. So the corporations, there's going to be a lot more zombie corporations. If there's, I think we're well over 10% of total corporations are zombie corporations. That number was from a couple years ago when the amount of corporate borrowing was still increasing. So we're probably going to be over 20% of all corporations are going to be zombie corporations in the near future. And those zombie corporations, those employees are collecting paychecks, but that company is not making money. They're barely able to make interest payments on debt. They're barely keeping the doors open. Oh, okay, board name. Yeah, I would agree with that. Yeah, all these credit bubbles are they're getting much larger. It's not sustainable for them to keep growing and growing and growing. There's a time where they will eventually pop. Well, the other thing there you mentioned with student loan debt and car loans and credit card debt is that normal family creation for people in my generation is basically delayed or broken. There's other reasons for that, but the financial reasons are a very, very big one. You have inflation and taxes. You have people in a relationship bringing enormous amounts of student loan debt to the relationship. A lot of times someone in the relationship lies about the student loan debt. I've been reading stories on Market Watch Personal Finance of how like someone marries someone else and then finds out, doesn't do a background check or credit check or anything like that, and then finds out later that their spouse has like over $100,000 or over $200,000 in student loan debt, massive credit card debt, or a combination of these things. And then the husband normally pays off, because he's in love with his wife, pays off the debt, and then the woman divorces the husband as soon as the debt's paid off. That's becoming very, very common now, unfortunately, here in the United States. I think I read 3 stories about that in just the last couple months. It's becoming very, very common. When is it going to pop? Who cares? Unless you're a hedge fund trader and you're trying to time this, why does it matter the exact timing of when it's going to pop? The exact timing should not concern you unless you're a professional money manager or you've set up all these trades. The exact timing of these things doesn't really matter. In fact, a lot of people were given an extra 10 years to prepare. An extra 10 years was bought for a lot of people. That was a lot more time to prepare than a lot of other very smart people were predicting. So I have a Mish article from, let's see here, July 1st. The Bank of International Settlements annual report fired off a plethora of warnings to central bankers, yet missed the best warning of all, bubbles. Let's see here. Let me get to the part about there's the CLO part. Leveraged loan market. The corporate sector in some countries has shown clear signs of overheating. The most visible symptom of potential overheating is the remarkable growth of the leveraged loan market, which has reached some $3 trillion. Okay, that's not in the Fed research I found. Investment grade bonds has collapsed. The share of bonds with the lowest investment grade rating in investment grade corporate bond mutual fund portfolios has risen from 22% in Europe, 25% in the US in 2010 to around 45% in each region. So the lowest grade corporate bonds in bond mutual fund portfolios has risen from 22% in Europe, 25% in the US in 2010 to 45% in each region. So it's almost doubled. It's doubled in Europe, about doubled in Europe, and it's a little under doubled in the US. Let me find the section here from this Mish article on zombie corporations. Zombie corporations, here we go. Firms, quote, firms that are unable to cover debt servicing costs from operating profits over an extended period and that have muted growth prospects, so-called zombie firms, have been on average 40% more leveraged than their profitable counterparts. They sap economy-wide productivity growth, not only by being less productive themselves, but also because they crowd out resources available to more productive firms. Evidence suggests that their increase over time has had an economically significant macro impact. You see if there's an exact number quoted in this article for the zombie. I don't think there's an exact number quoted in this article for the zombie corpse. I thought there was going to be. Okay, the Bank of International Settlements found that a 10% decline in nominal interest rates since the mid-1980s accounts for around 17% of a six-fold rise in the number of zombie companies, although in reality the number may be far higher. This report is from, I think, 2018, this one. I'm jumping articles because I have 6 articles open. The report also found that once a company becomes a, quote, zombie, it tends to stay that way for longer rather than recovering or exiting through bankruptcy. While in the late 1980s, zombie firms had 60% chance of staying in that condition the following year, the probability reached 85% in 2016. The main culprit naturally is low interest rates, which have helped these firms stay afloat by reducing their financial pressure to reduce debt. Another factor is the symbiotic relationship between creditor and debtor. Once, quote, zombie balance sheets are impaired, banks have incentives to roll over loans to non-viable firms rather than writing them off. This implies that weak banks played a role in the wake of the global financial crisis by inhibiting corporate restructuring. Poorly designed insolvency regimes were also at work. Quote, lower rates boost aggregate demand and raise employment and investment in the short run, but the higher prevalence of zombies they leave behind misallocate resources and weigh in productivity growth, end quote. The report notes and adds that, quote, should this effect be strong enough to reduce growth, it could even depress interest rates further. So it's becoming a vicious cycle. It's still a positive feedback loop, but it's with negative consequences. Or negative outcomes. Hey, thanks, Wendy. I'm glad you liked the show. So just more and more distortions from ZIRP and NIRP. Okay, let me read more from the Jim Bianco article that came out today. The trend poses for negative yielding corporate debt, the amount of explosion. It's gone from only $20 billion, guys, in January of 2019 up to over $1 trillion now. So in less than 9 months, it's gone from 20 billion of negative yielding corporate debt up to over $1 trillion. The trend poses a potentially dangerous threat, especially if market winds shift and bondholders looking for price gains rather than yield get stuck holding too much risk. Quote, the interest rate risk that these bonds carry is huge. Jim Bianco said in a recent interview, the financial system doesn't work with negative rates. If the economy recovers, the losses that investors would take are unlike anything they've ever seen. Negative yields have been confined to places outside the U.S., though some Federal Reserve officials have toyed with the idea, at least in a hypothetical sense. Former Federal Reserve Chairman Alan Greenspan recently jolted some investors when he said there was nothing actually standing in the way of negative U.S. rates. Most of the negative yielding corporate debt is in Switzerland, while some also is in Japan, Bianco said. Investors don't actually pay to borrow money, but the negative yield is symbolic of how much above par investors are willing to pay for these bonds. That's because those who buy negative yielding bonds are essentially making a bet that rates will stay low and prices will rise, which is the traditional, and that's what Stanley Druckenmiller is doing, which is the traditional relationship, and the people who copy Stanley Druckenmiller, which is probably a good percentage of hedge fund managers, the trend traders, short-term oriented guys, which is the traditional relationship when it comes to fixed income. Should rates start to rise even a little, that will start to eat into the capital appreciation that bondholders have been enjoying. For instance, Bianco said if yields on Swiss bonds go up just 2 percentage points, it would amount to a 50% loss for bondholders. So basically then some hedge funds will blow up. On this, they probably use leverage to buy these bonds. They probably borrowed money or did some what was being recommended in a Bloomberg article last week, which was do leverage trades with forwards and swaps to profit off of negative yielding debt and NIRP. And they could suffer a 50% loss if the bonds go up just 2 percentage points. While some individual investors might be able to absorb such losses, they would be catastrophic for institutions. So it sounds like there's going to be a lot more long-term capital managements out there, not just with the CLO market, the collateralized loan obligation market, which I covered, not just with the leverage short volatility trade, but now also betting that these negative yielding corporate bonds will go even more negative and only betting on capital gains using leverage, even more leverage. A wall of new money. On the sovereign side, Germany is the starkest example of negative rates, with yields all along the curve. They're trading below zero. That has pushed prices up dramatically in Tuesday trading. Buyers were paying the equivalent of $195.87 for every $100, wow, in 20-year German bunds. Wow. All for a technical yield of minus 0.386%. Bianco attributes the negative yield trend to entities including the European Central Bank pumping money into the financial system and pulling investors along for the ride. Quote, they've so flooded their financial system with money that there's not enough alternatives, end quote. And they've also they've created artificial demand for these bonds that are not adequately pricing in risk. Quote, that's why you have people saying such astronomical prices that you want, that's why you have people paying such astronomical prices that you wind up with negative yields. On the corporate side, the picture isn't much prettier outside the U.S. The $27.8 trillion of non-U.S. dollar investment-grade global debt is collectively yielding just 0.11%, according to Hans Mikkelsen, credit strategist at Bank of America Merrill Lynch. Probably need a swig of water. Of all the global investment-grade debt delivering any yield, 95% is from the U.S. Kyle Bass was talking about this recently in interviews, that the U.S. is the only company with positive yield, and I was debating on whether or not to do a separate show on this, but this is very, very reminiscent of the historical period from 1927 to 1929, where tons and tons of net capital outflows came from other countries, especially emerging markets, European Union, etc., and came into the United States back then from 1927 to 1929. It came into the stock market, and the stock market had a blow-off top until the October 29th, 1929 Black Tuesday crash. It seems that all of this hot money, this capital flight, the net capital outflows from other countries that are net capital inflows into the U.S., a lot of that money is coming into the U.S. Treasury market. You can see it on the tape. You can see it in price action. The 10-year U.S. Treasury bond is down to 1.577%, and last October it was at 2.78%. So we could be setting up for its similar price action, similar capital flows, net capital outflows out of European Union and emerging markets, similar to what happened in 1927 and 1929. And that's why things are getting ridiculous in the U.S. corporate bond market. In the U.S. Treasury market, and there will probably also be spillover into the U.S. corporate bond market as well. Hey, Anthony, I cannot give financial advice. I can only give my opinion. I get people messaging me for stock picks and all this other stuff. It's just for no one tips on, well, some people don't tip on Super Chat. If you tip on Super Chat, I'm more likely to answer your question. What I probably should do now that it's easier is Vimeo allows for immediate direct uploads to Patreon. So I should debate. I'm not sure what I would do on a monthly basis for my Patreon contributors, but maybe I'll take feedback. You guys can email me if you have suggestions on what I should provide you guys extra. If you're a Patreon contributor, maybe once a month do something that's Patreon only behind the paywall there. For my 100+ Patreon account contributors and my half a dozen or so PayPal. But it's now easier to upload videos directly from Vimeo behind a private video up to Patreon now. But there's a lot of people. I get messages under all videos, messages in live chat, emails asking for opinions on gold mining stocks. Some guy even, and thank you for sending me $100. I really appreciate it. Sent me a list of gold mining stocks for me to give my opinion on and look at. Some of the research guys to do this stuff, it takes hours per company. That's how thorough I am. So in the past, people hired me for research to do that and gave me a list of companies and prepaid some money to do research. And it took like 2 or 3 hours per company. I was very, very thorough. I went through the annual report, the financial statements, insider stock purchases. I looked through management discussion and analysis. I was doing all these things to see if management was doing what they were saying they were going to do. If there were big CapEx bills coming up. That's a full-time job. So asking for free stuff is not really conducive. There's tons. I get emails all the time from people trying to get me to do more and more free work for them. It's just, sorry guys. I appreciate the people who tip on Super Chat, and the people who are my Patreon account contributors are going to be taken care of first. They're at the head of the line. Maybe I could also do like some type of like ask me anything behind the Patreon where I actually do if people send in questions and I answer questions or something like that. So I have a couple hours to go over. Maybe I could do something like that. I have to figure out. Comments on a lot of stocks, on my opinion on stocks, like in the comments section or live chat below videos, probably not going to get, most of them won't be answered. Just there's too many of them. I'm getting like over 3 dozen emails per day. So even responding to a certain amount of emails is just hours and hours, time, way too time consuming, considering all the other things I'm trying to do in my life right now. And my health problems and all the other stuff. And anything else normal that I want to do. Wow, the Bureau of Labor Statistics admitted that there are at least 500,000 less jobs the economy added than previously reported. These downward revisions, guys, in GDP and jobs always happen. They've been happening for a decade. They happen like 2 to 4 months later, and the high-frequency trading algorithms don't care. The high-frequency trading algorithms only care about the headline numbers. Most of the people on Wall Street don't even care about the revisions, the downward revisions. You'll never hear people talking about the downward revisions, really. Okay, I'm going to look at listener questions and comments. There's 6 articles. If you want to read more about this, about how there's negative yielding junk bond debt, which a lot of people thought would not happen. 10 years ago, if you would have told people that there would be negative yielding junk bond debt, financial professionals, they would have laughed at you. But now we're up to over $1 trillion in negative yielding corporate bonds. Just insane. Cat Piss Sniffer says we are running out of real stuff to give all this debt its perceived value. According to Richard Duncan, we haven't done nearly enough, and I think this is why his thesis is extremely flawed, because tens of trillions of dollars in fiat currency, not just dollars, but actually China has created even more since 2008. I've outlined that in a video a month or so ago. But over $65 trillion in additional fiat currency and credit in bailouts, secret bailouts, stimulus programs, credit has been created. And Richard Duncan says that global governments should create $100 trillion and then throw it at new industries like nanotechnology, space rockets, space travel, any type of new industry, and hope we hit on something and get $1 trillion industries with new jobs. Rather than, he thinks if you don't do that, then it'll be World War III. That's his, and that there'll be a massive culling of the global population. But to a certain extent, look, we've already done it. And that's just to maintain the status quo. I laid out a pretty coherent argument that at least I could easily prove at least $65 trillion in fiat currency and credit has been created since 2008. So what, another $40 trillion? Throwing it at what, new industries? How did it go when we threw a lot of money, subsidized money at windmills, solar? I would argue that almost all of it has been wasted in misallocation of capital. There's been enormous amounts of waste, fraud, corruption, and abuse in a lot of the alternative energy technology industries and companies. I think Adrian Day is a good stock picker. For some reason, he doesn't like Sandstorm Gold. I don't know why, but whatever. Andy asked a great question. Who is buying all this negative yielding bonds? Okay, so as I've said before, I've talked about this many, many times. Maybe I haven't specifically highlighted this, but I've talked about this many, many times. It is professional money managers who cannot hold cash. It is pension fund managers who are not necessarily smart money, or pension fund investment boards who got suckered by Wall Street investment banks, hedge funds, and private equity. And then it is insurance companies. Insurance companies, this is not financial advice, but there are insurance companies who have bought a lot of this garbage, and they've bought a lot of these collateralized loan obligations. The insurance companies are, you can see this now with negative yielding debt in Europe and negative interest rate policy in Europe, that European insurance companies have had big losses, and that will be coming to the US. So American insurance companies are going to be in big, big trouble. Because insurance companies, it is a required by law here in the US that insurance companies buy a certain amount of bonds. They have to hold a certain amount of bonds. So pension funds, insurance companies, professional bond fund managers, even if they know that the majority of almost all the bonds available are garbage. So there's different degrees of garbage, different degrees of crap, different degrees of toxicity. They still have to buy it. Otherwise, if they don't buy the stuff and they know it's garbage, if they don't buy it, they're going to get fired. And then they won't get hired again. So they're risking their entire career by not buying this garbage. So basically, the system for professional money managers, especially bond fund managers, pension fund managers, and now insurance companies, there is perverse incentives for them to buy this garbage, because if they do the right thing and don't buy this garbage, they'll get fired. If they go to cash, or they buy gold hedges or other things other than this toxic debt this toxic corporate debt that's negative yielding, these government bonds that are going to be inflated away, then they risk losing their jobs and getting fired. And what the funny thing is that the professional money manager industry is being automated anyway. It's being automated to index funds. So these guys may be fired 5 or 10 years from now anyway, no matter what. Because a lot of these, I just read an article a week or two ago about how $77 trillion in professional assets under management they're looking to replace the active money managers and replace them with index funds or high frequency trading algorithms where there's hardly any people like me doing any research or warning people that that's a bad idea. They want to go either to indexing and have very little employees. And the Chinese understand this indexing game, and that's why China's going after American retirement accounts now. They're bullying, the Chinese government is bullying their way into the global bond fund index, and they're putting in these basically fraudulent Chinese state-owned enterprise bonds into the global bond index fund, and that's a lot of American retirement account money. So if you if you're against China in this trade war, if you're an American and you're against China in this trade war and you have money in a global bond fund account, your money, some of it is probably going to fund the Chinese government. The Chinese government is bullying their way. They got Michael Bloomberg to do this, that they've allocated now a percentage of Chinese state-owned enterprise bonds into the global bond fund index, and there's going to be a wealth transfer of approximately $3 trillion from American retirement accounts into the Chinese government. My friend Emma Molman has been covering this. Might be time to have her back on and talk about things. Kyle Bass has been talking about this. There's been other hedge fund managers that are talking about this. The bond market is a very sophisticated scam. Your wife has been yelling at you for prepping the last 10 years until about a year ago. Now there's quiet approval. This is what happens during a depression. When the economy gets worse or markets crash, is that even when you're right, people hate you. John Maynard Keynes actually talked about this. He said it's better to be wrong with the crowd than better to be right with a couple people. That's what he said. I disagree with him, but that's what he said. Okay, let me look at this last zombie company article. This is from June 30th of this year from Mayra Rodriguez Valladares. Highly leveraged zombie companies threaten the global economy. Zombie companies could endanger financial stability as the global economic downturn is deeper than expected. The very detailed analysis and graphs from the Bank for International Settlements annual economic report show in no uncertain terms that one of the biggest signs of overheating in the global economy is the level of below investment grade corporate debt and the $3 trillion of leveraged loans. As prolonged trade tensions impede corporations' ability to plan for the future, geopolitical tensions intensify, and she's saying the Chinese continue to deleverage. That's not the truth. They attempted briefly, maybe for a short amount of time or something, but... Okay, any of these factors could trigger a significant recession in multiple countries. What truly worries the writer of the article is the middle of page 12 in the report. Quote, the overall landscape is one of a global economy that has been unable to jettison its debt-dependent growth model. Indeed, well, and that's because we have digital debt-based fiat currencies all over the globe for the first time in history. Since 1971, we've been on a Keynesian digital debt-based currency experiment, and now we're digital. That's digitized. And that was the first time in world history that there was never at least one currency on gold backing. No mention of this in the article. So debt-dependent growth model. Indeed, aggregate debt, public plus private in relation to GDP, while it plateaued in the past year, is much higher than pre-crisis. Bank of International Settlement analysts clearly explained that, quote, at the same time, interest rates, nominal and real, remain historically low, even as economies hover around estimates of potential. And financial conditions in advanced economies, notably in the largest among them, remain accommodative from a longer-term perspective. As accommodative means dovish, I guess, which means like rate cuts, QE, lowering reserves for banks. I explained the difference between what's hawkish and what's dovish. So dovish is cutting rates. It is quantitative easing programs, buying up, creating fiat currency out of thin air to buy bonds or buy stocks, buy exchange traded fund stocks, which is what the Bank of Japan is doing. And then also lowering reserve ratios for the banks to try to get the banks to create more loans, fractional reserve lending. Okay, as a result, should the global economy slow down at some point, it is hard not to imagine that the debt burden would increase further. Gross domestic product, GDP relative to expectations, global trade growth, new export orders, and purchasing manufacturing indices, all important economic indicators, are unfortunately showing a global slowdown. Those companies that have not used their borrowing wisely to expand their companies and to pay all workers competitive wages, or which have been borrowing funds to pay back existing debt, pay dividends, or to buy back shares, would be the most vulnerable in an economic downturn. As the global slowdown continues, these zombie companies will intensify their firing of employees. In turn, many of the unemployed will be unable to pay back their personal debt, such as credit cards, auto loans, mortgages, and student loans. Although here in the U.S., student loan debt cannot be discharged in bankruptcy, household debt, especially in the U.S., has increased significantly since 2008. And that's because people are being killed with currency debasement or inflation and taxes. And while some people have gotten slight wage growth to make up for the standard of living decreases or to maintain their standard of living, they have used credit cards. The data is proving that a lot, especially just in the last couple of years, despite the Trump tax cuts. While the biggest corporate the Trump tax cuts clearly did not benefit everyone, while the biggest corporate borrowers of all kinds of debt, some idiot who I blocked actually called me a slave of Trump, a worshiper of Trump. I mean, I routinely criticize Trump. What an idiot. This guy claimed to actually know anarcho-capitalism and the non-aggression principle. It's really funny because the non-aggression principle, not only does it apply to using the government to not not only does the non-aggression principle apply to not having the government harm you, but it's individual parties, to private citizens. So if you steal someone's property, you're violating the non-aggression principle because it's two private people and you're not doing voluntary transaction. You're stealing someone's property. You still violated the non-aggression principle. Apparently, libertarians don't even know that. Some libertarians. While I've met a lot of libertarians who haven't even read any Austrian school economics. I don't even think they've read even the one article or a beginner's book. Well, I know Gary Johnson didn't. While the biggest corporate borrowers of all kinds of debt, especially leveraged loans, have been in the United States and the United Kingdom, companies in other countries have also taken advantage of the prolonged climate of low interest rates. According to Augustine Castens, general manager, Bank of International Settlements, quote, high levels of debt also point to vulnerabilities in a number of emerging market economies. In some cases, these are the household sector. Most often, they are in the corporate sector, not least as foreign currency debt has expanded strongly since the crisis. The current vulnerabilities reflect in part spillovers from prolonged accommodative monetary policies in advanced economies, as emerging markets are especially vulnerable to capital flow reversals, which capital outflows, net capital outflows. I've been talking about this for weeks because net capital outflows out of stock markets in emerging markets or bond markets in emerging markets, net capital outflows have normally been one of the symptoms of an impending crisis in emerging markets, whether it was the Asian tiger crisis or Argentina in the late 90s, early 2000s. And exchange rate fluctuations. Our emerging markets are especially vulnerable to capital flow reversals. So that's after money comes in, money leaves quickly. That's hot money coming in, hot money going out, and exchange rate fluctuations. Particularly worrisome are countries in emerging markets where the sovereign or companies have borrowed in foreign currency. So they're talking about dollar-denominated debt, which the gold community does not like to talk about. If economic or market downturns hit those countries, their currency will depreciate, making it harder for borrowers to service their foreign currency loans. Investors' chase for yield has influenced a significant demand globally for structured bonds, which pool leveraged loans, collateralized loan obligations. According to the BIS Annual Economic Report, CLOs have surged, reminiscent of the steep rise in collateralized debt obligations, or mortgage-backed securities, MBS, that amplified the subprime crisis. Bank of International Settlement economists warn that, quote, should the leveraged loan sector deteriorate, the economic impact would depend on the potential amplification mechanisms. These can run right through the banking system, linked to unstable wholesale funding and other parts of the financial system that hold leveraged loans and CLOs via price adjustments. The probability of these factors taking effect is best assessed against the backdrop of the longer-term deterioration in credit quality of the corporate sector in some advanced economies, visible in the concentration of the outstanding stock of securities in the BBB segment just above non-investment grade or junk status. The amount the amount outstanding of CLOs in the U.S. has been growing every year since 2013. For the last few years, CLO issuance has been averaging over $100 billion. The amount outstanding, according to this research from the Bank of International Settlements, is now about $700 billion. Remember, I showed you guys the Federal Reserve research report. They said it was over $600 billion last week. So they are saying here that the amount outstanding in the U.S. is now over $700 billion. According to LCD News, about 15% of leveraged loans rated by S&P Global Ratings in the U.S. have a negative outlook, up from 2.5% at the start of 2018. In the United States in particular, the ratio of debt to earnings in listed firms was above the previous peak in the early 2000s. And this is talking about leverage in emerging Asia was also higher, but below the level immediately preceding the 1990s Asian crisis. Moreover, lending to leveraged firms, i.e. those borrowing in either high-yield bond or leveraged loan markets, has become sizable. In 2018, leveraged loan issuance amounted to more than half of global publicly disclosed loan issuance, loans excluding credit lines. The concern is, in previous columns that the author has written, that if financial conditions tighten, either because interest rates rise in certain countries or because rates to borrowing companies rise due to their credit quality deterioration, meaning that their credit rating is downgraded, leveraged companies will be very vulnerable. Okay, there's more to the article. I won't read it right now, but just there's a lot of red flags here. What's my opinion of the third largest bank, Jyske Bank, if I pronounce that correctly, in Denmark, having introduced negative interest rates on consumer deposit accounts with deposits above 1 million euros? This is the new normal, Michael. Thanks for the question. This is the new normal, Michael, unfortunately. So I would expect that to happen more. Most people are not going to keep their money in those banks. What will happen, and I explained this in the last couple weeks, is that rich people will take their money. This will unintended cause bank runs. So rich people and people who are not so rich will start to pull their money out of banks. And the rich people, what they will do is they will create non-bank cash storage warehouses where it acts like a bank and there's guards and there's a vault, but it's not a bank. So some other entrepreneur businessman will buy a warehouse, hire private guards with bulletproof vests, Uzis, all the security stuff. There will be vaults, and they will store cash, and it will not be part of the official banking system. You're gonna, and then of course it will probably be laws to outlaw this. Hey, thank you, Tarkinas, for the super chat. I appreciate it. When is all this going to collapse already? This is why it's dumb to make a prediction on exactly when, because behind the scenes, Veritas Arrow, all the people in power, the economic and political elites, the politicians, the central bankers, all these guys, they just change the rules. They only announce the rules changes when they want us to know. There are covert backdoor bailouts. There are covert rules changes. There is covert quantitative easing behind closed doors all the time. It's been going on for a very, very, very long time, since 2008. How much do I think the U.S. Treasury could borrow from the market using 20 and 30-year bonds? The market seems hungry for long-term, low-yielding debt. Yeah. The insurance companies, the pension funds, the bond funds, the bond index funds, they want to buy Treasury debt. So I think the U.S. government in the short term, obviously in the long term, they're giving themselves more rope to hang themselves with by taking on more debt. But in the short term, they can borrow a lot. Now, when the U.S. gets to ZIRP, and then, God forbid, we get to NIRP, it sounds like more people at the Federal Reserve are open to NIRP than were even a couple years ago. That will change. But right now, the U.S. has positive yields, at least in nominal, relative to all the other countries. That's why the capital's coming here. This is very similar to the amount of capital that flooded the U.S. stock market from 1927 to 1929, except a lot of that capital now, guys, is going into the U.S. Treasury market. And then you have spillover, like I said at the beginning of the show, into the corporate bond market now too. And this is how the zombie companies, there's a number of reasons I read in the different articles. There's 6 articles if you want to read them and go in depth on this. But this is how the zombie companies are taking advantage of the system. So there is a lot of other General Electrics out there. I know the hedge funds are looking for them. And we have had some, what's the right phrase here is accounting fraud. We have had accounting fraud at large corporations recently revealed against Disney by Francine McKenna and a whistleblower at Disney, that Disney was committing accounting fraud. So it's not surprising that these companies that borrowed a lot of debt and lied about their cash flow and their earnings and their revenues, overinflated their revenues, have been committing accounting fraud. This is the desperation that these companies, these large companies, get into. Argentina, the 100-year bonds lost about 55% of their value already in about 3 years. But if you're referring boring name to something else, that was the Jim Bianco article I read at the beginning of this live stream show, talking about negative yielding corporate bonds going from only 20 billion in January up to over $1 trillion now, so less than 9 months. And he is talking about how if corporate bonds, if there were to be a 2% interest rate increase, corporate bonds could lose 50% of their value. He's a very well-respected global macro researcher. Okay, guys, well, my voice is getting tired. I'm going to go relax. So I'll talk to you guys later. Thank you for the super chat, Tarquinas. I appreciate it. And the articles will be in the information and description section afterwards. But bottom line is, as all these major central banks, and if things get worse in China, China will go to ZIRP too. China will go to zero interest rate policy. China will go to NIRP and try to probably slow down the amount of defaults. China will also start creating and allowing, creating, sustaining, even rewarding these zombie companies as well. This is going to be a large global problem. It's been this way for a while, but it's gotten worse and worse and worse. And I don't see this changing going forward unless the central banks are suddenly stripped of their power and not allowed to do ZIRP and NIRP. But it does not look that way. Okay, bye for now.